When we're investing in property, of course it's really important to understand what the upfront costs are, but also what the ongoing costs are. One of the biggest surprises we get from most clients when we teach them how to invest in property, what the ongoing costs are, how the rent and the tax benefits usually can pay for just about everything or everything. So most of the time there's either a very small cost or there's no cost, or sometimes it's even slightly positive cash flow. And that's on a normal, typical property in a metropolitan area. Now, of course, you can even find properties that are positive cash flow. But to understand which strategy is right for you, whether you want to go negatively geared, neutrally geared, or even positively geared, it's really important to understand how the cash flow of property works. Now, first we're going to start with the upfront costs. It's a bit simpler. Those things you pay once when you buy the property. So let's think of a nice round number so we can just talk about what those upfront costs are in a simple ratio. So if we think about a $500,000 property, so the main cost when you buy it, other than the property of course, is the stamp duty. Now the stamp duty is normally just under 4% for a complete property. So for a $500,000 property, 4% would be $20,000, so it's just under that at about $18,000. The next biggest cost is legal fee. So your conveyancer or a lawyer that's going to process that transaction and help give you advice about how the whole property purchasing process legally and administratively works. There's normally some government fees, and that's registration of title, registration of mortgage, a few smaller costs like that. Normally they're processed through the lawyer or the conveyancer, and they handle those things called disbursements. If we're buying an investment property, we also want to buy what's called a depreciation report. And that depreciation report, we only have to buy once. It's a bit like a building inspection, but it tells us what we can claim as depreciation. So if the property is less than 40 years old, there's normally some depreciation left in it. If the property is brand new, there's still 40 years of depreciation left. So it's really important to get that depreciation schedule, because it's that person that works out how much you can claim in depreciation every year, and then we give that to the accountant. Now, one of the other costs is a building inspection. So even if we're buying a brand new property, we still recommend getting an independent building inspector to make sure everything is done up to a certain standard and that it's all built to code. Normally a building inspection costs about $600 to $900. But the good thing is you get a professional building inspection to make sure everything is done well, and they provide a report that we can then give to the vendor to make sure any other defects are rectified. And also allow a little bit for some advice. One of the most important things you can do when buying property is to get some good advice. And that's probably one of the best investments you can make. Often the advice, or almost always, the advice should be a better investment than the property itself. So always allow a bit to get some good advice. If we're going to invest in a $500,000 property, we should allow at least a couple of $1,000s for some good advice. That's about less than 0.5% of the property value. Now, coincidentally, the total purchase price plus costs ends up at $525,000. So the costs are about $25,000. Now, of course, they can be a bit less and a bit more, but that's a good budget to work to. Now, the next most important thing is understanding the cash flow. So what is the property going to cost you from when you settle each and every year? So if we think about that $500,000 property and add the costs, we need to borrow the whole purchase price and the costs if we're using equity in another property to buy it. So that's the worst case. That's the most amount of borrowing we will have for that property. The purchase price plus the costs. So when we're doing cash flow for a property, we want to make sure we cover all of that debt. Now, the most expensive thing in ongoing cost, of course, is interest. If we're using an interest-only loan, which is what we usually recommend for investment property, all we need to do is work out what the simple interest is, and that's the interest rate times the loan amount, gives us the annual interest, and then we normally prefer to do cash flow in a weekly budget to make it more of a tangible amount. So if we divide the annual interest by 52, that gives us the amount of interest per week. Now, it's really useful to remember this little rule of thumb. If you're borrowing $500,000 or $525 and the interest rate is about 5%, normally the interest cost is about $500. It's normally roughly $100 interest per week per $100,000 in borrowings. Most of the time you'll get a better interest rate than 5% at the moment. We can often get down to 3.8% or 4% for investment property interest-only loans at the moment. But if we use this higher interest rate to make sure that we can afford it, when it goes up to 5%, that's a good starting point. Now, if we add in all the other costs, what are all the other ongoing costs of property? So of course we normally have, almost always have council rates. Normally that's about $1,300 per property, sometimes a bit more, sometimes a bit less. There's water in most states. The vendor has to pay the water and then the tenant might have to pay the usage beyond that. So we want to budget for that. The next cost is insurance. And there's two main insurances we can take out. We should always take out house insurance, so there's building insurance. And normally for a $500,000 property, it's roughly $600. And then you can also take out what's called landlord insurance. So landlord insurance is insurance that protects the landlord from any damage the tenant might cause and any lost rent you might get as a result of that damage. Normally landlord insurance costs about 1 week's rent and house insurance costs about 1.5 weeks rent. Both of those, in fact, pretty much all of these costs are tax deductible. You want to budget for a little bit of ongoing advice, and we normally charge $20 plus GST to continue to give you advice and to help you manage your portfolio. Of course, there's maintenance. If it's a brand new property, we should have far less maintenance cost than this, but we want to budget for a reasonable amount of maintenance ongoing. Whether it's a house or a unit, there's always some maintenance. So if we allow, say, $2,000, that should cover us most of the time. You need a property manager to manage the property. We always recommend getting a good property manager to manage it instead of managing it yourself. And normally the property manager will charge roughly 7% of the rent plus GST. And in this case, if we're getting $450 a week rent, the property management fee is 7.7% of $450, which gives us $34. There's also a letting fee. So every time you need the agent to find you a new tenant, they'll charge you a once-off fee called a letting fee. And normally that is 1 to 2 weeks rent each time you need a new tenant. So if we needed a new tenant, say every 2 years at worst, and it was 2 weeks letting fee, we're averaging 1 week's letting fee per annum. It should be a lot less than that most of the time. And lastly, we want to allow for some vacancy. Sometimes you'll get 100% occupancy and no vacancy. Sometimes you'll have more vacancy. The natural vacancy rate across most of the capital cities now is about 2%. Some areas lower and some areas higher. But at least we want to budget for some vacancy on the ongoing cash flow. That's all the costs. So if we add all those up, that gives us $677, which sounds like a lot, of course, until we take the rent off. Now, if we're getting $450 a week rent, the cost is $677, the difference is $227. Now that cost is actually the amount called the negative gearing amount. And that cost is a full tax deduction. So you claim that on tax, and whatever tax rate you're on, you get that amount of tax back. You don't need to wait till the end of the year to get a lump sum back. We can actually do what's called a tax variation, so you can get your tax back every payday.